righty, Greg, what's happening?
Morning. I guess it's afternoon for you. It's still morning for me.
Yeah, it is afternoon for me. And I just got back from a 36-mile bike ride, which is why I look a little schwitzy.
Nice. Nice.
Yeah, on a day like today in the market after yesterday, I needed to blow off some steam.
Seriously, unless you were net short over the weekend, which I don't know how anyone... I don't know. I suppose you could have gone net short.
Well, actually, I did enter a new trade on Friday that was very bearish on Apple and did very well. So nice. I expected to be, I don't know if you saw that. I expected to be in the trade for about, well, it was a 27-day trade, but I hit I exceeded my target profit in less than 3 days. So I had to follow my trading plan and close it. So I didn't expect the trade to last that quick, but that's why we define our trades. So,
well, I agree with that. And, before we started, I was complaining about my trade over the weekend too. I actually didn't hold it over the weekend. I went short the Qs. Well, by short, I bought puts on the Qs on Thursday last week, sold them on Friday for a little profit. I didn't make a ton of money. We had a little bit of a down move on Friday, but not horrible. Wish I would have held them over the weekend, but if wishes were fishes, right?
Well, the trade that I did on Apple was actually what I call the George Costanza trade. And that's doing the opposite of what you think is going to happen. So I thought Apple was going to go up, and I placed a bearish trade with the plan to adjust it if it went bullish. My adjustment would have involved a covered call, and we were going to talk about covered calls, some interesting stuff about covered calls here real quick. So first I wanted to say thank you for those of you that have been watching the videos, and I've gotten some people reaching out to me either through social media or email. That's great. I appreciate that. But the better place to leave comments, because it'll help us out and to get a better handle on what's happening, is if you like and subscribe. So hit that little bell to get notified when there's a new one. And then also feel free to ask questions in the comments down below, or provide your comments because that'll help us. If you got questions, we'll answer them down below, but it'll help us with future content. So please make sure you like, subscribe, and comment on the YouTube. One feature we did get was, holy crap, that was long. So I think we went an hour and a half on the last one. The other one was around an hour. So we're trying to keep these shorter and more to the point. Although we had I thought a lot of good stuff. I got good feedback. It was just long.
Well, to the point. We were discussing a couple of pretty big economic summits that we both experienced in the last month or so out here in the Rocky Mountains, as well as your experience at Camp Kotok in Maine. So now we're just back to being everyday traders. Right.
I think yeah, for sure. But I do think some of that stuff is germane, because there's some stuff that you're not seeing in the narrative, and that's why we share it. So hopefully people did take the time to watch some of that. So there's some larger themes there.
So interesting developments since our last conversation. And by the way, for those of you who are new to this podcast, you don't know who we are yet. Sorry, we just start talking to each other. I'm Greg Jensen. I'm the CEO of OptionsANIMAL. We're an education company specifically focused at teaching retail investors, individual investors, how to manage risk in the market. Eric, I'll let you introduce yourself. I won't do it.
Yeah, so Greg and I are partners. We work together at OptionsANIMAL, but I'm also leading an effort to create a trading platform, which we have up and running, but we've got a new major release coming out really soon. And it's specifically designed for retail option traders to manage their trades better. And it goes hand in hand with what we teach at OptionsANIMAL. So really excited about it. We've got great feedback. And like I said, we have a current version, but we've got a new version that's coming out that's a lot easier, and we think will be very attractive for a number of reasons. We'll talk more about that on future podcasts.
So markets rolled over the last few days since we talked. Markets rolled over pretty harsh, actually. Friday, we talked a little bit about this right at the open. Friday was a down day. Yesterday was a big down day, worst day since June, individual day. And today trying to hold up a little bit, but news wise, I haven't really seen anything major. Maybe a couple things around housing. What are your thoughts? Do you have thoughts on what's rolling the market over right now?
No. I mean, sometimes we just have volatility. That's sometimes the market goes one way or another. It's difficult to pin down why a market does what it does from day to day. Now, this was a significant down move, and I think what I heard in one of the news reports was the biggest down day since June of 2020 or something like that. So definitely a significant gap, and it was noticed yesterday. But there wasn't any major announcements. I mean, the Fed is in the quiet period right now, so we didn't see any major Fed discussions. We know that Jackson Hole's coming up this weekend. There were some economic reports around, as you mentioned, housing that was out. Let's see. So the Chicago Fed National Activity Report was out yesterday. That's not a major report that generally moves the market. It wasn't good, but that happened yesterday. I mean, over the weekend, there's concerns about what's happening in Europe. And we talked about this on the earlier podcast, how fuel prices are going to have a dramatic impact on Europe. And there is some impact here on our energy prices as it makes it more attractive for oil or energy producers of oil and gas to export to Europe. So I don't know that that's what was driving the market. Maybe it was. I mean, that was big news over the weekend. So sometimes we just have the markets, they do sometimes move and there's a crowd and everybody follows in the same direction. And why are we going this way? I don't know. Everybody's going this way. So I think it was just one of those, a random day, but because I didn't see any specific news that pinned it. And maybe it'll become clear later, but there wasn't anything that was flashing like warnings for me.
I have to say that I think a lot of it was just we had come too far up off the bottom too fast. I think the rally that we've had since the middle of June, the month of July was really bullish. And to be honest, the rally didn't have any, in my opinion, really any basis behind it, because the story, other than that, there was some argument that maybe we've hit peak inflation. I still think that's a questionable assumption right now, but that's really what we rallied on. The Fed has still been very adamant, at least before the end of their quiet period, that they haven't changed their tone. They're still going to battle inflation. They expect to be aggressive with interest rate increases. So I think maybe we have just seen the fact that the market rallied so fast and bullish that it didn't want to get too far ahead of itself, because we still have a pretty aggressive Fed in raising rates. And let's be honest, tech stocks are still a long duration asset. They based their valuation off of future cash flows. And if we've got an environment where we're expecting interest rates to increase, those long duration assets are volatile and they're going to go down in the short term. So I think that's what we're seeing as much as anything. That's why I think the NASDAQ especially has been hit harder the last couple of days than the other two major markets. Some of the big, really fast names, the high PE multiple stocks, they've really been the ones that have taken the hardest the last few days. So, but I agree with you. Other than the housing data that continues to show the weakness in the housing market, I didn't see anything major. So yeah, I think it's just a function of markets taking a breather right now. The question now remains, are we going to go back to the lows in June, or will we find a higher low, which could be the indication of maybe the start of a bullish trend? That's the big unknown at this point right now is, how far down this now new bearish trend, this new rollover that started, how far down it has to go before it finds support.
I didn't have it up here, but I do know that the 200-day simple moving average was cited as a potential that, and there are a lot of people who are really excited that we got a touch and a bounce off the 200-day moving average. I don't know. I'm not a big technician, because if you look back at the last, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12 times that we hit it, I don't know that here we might have argued that we bounced off of it, but certainly that wasn't a bearish signal there. But I don't know, technicians are technicians. But from a technical standpoint, what I see that's interesting is we were way overbought on the RSI. This is the S&P 500 index. We were way overbought. The RSI up above 70. We don't tend to get up there very much. So, and this is a sort of, they call it an oscillator. So it tends to go back to 50. Crossing below 50 would be a bearish signal. We get the MACD and the signal line crossing. That would be a bearish signal here. So keeping an eye on the 5 and the 20-day exponential moving averages. And then the green dotted line, it's a little, well, actually, you can see it here on the right. This is sort of an expansion over here. We did cross below the green dotted line is the simple moving average, the 20-day simple, and the red is the 20-day exponential moving average. And so crossing below those, if we get the 5 crossing the 20-day, I would, we would consider that a triple bearish signal. So from a technical standpoint, so something to keep an eye on. And that's what I would need to confirm that this is something other than just volatility. I would say, okay, there's a bearish signal there that occurred. Until then, I think this does look like a pretty big move, but I still think the intermediate term here is bullish. And we don't have to agree. I like it when we don't agree, but
I like it too. That makes a market, right?
Yeah, exactly. If everybody agreed, then what were the prices? We wouldn't find fair prices. So
you sent me an interesting article this week.
Yeah.
That I think would be a good discussion point for today's podcast, and that is really the concept of risk. And it goes back to an article, as this article, of course, from Barron's, talking about litigation between a client and their broker, Charles Schwab, and their advisor, Pinnacle Associates, a registered investment firm, over a claim about covered calls and the idea of risk associated with a covered call. And obviously, the court favored the client here and is awarding them quite a sizable judgment.
$800K.
Yeah. And it's an interesting concept because the idea is, and correct me if I'm explaining this incorrectly, Eric, is that this individual was promised by Charles Schwab, not by Schwab, but by Pinnacle Advisors, who uses Schwab as the broker to execute trades. They promised a specific type of return. This retiree had shares of Apple. They didn't want to sell the shares. And so they pitched this idea of a layered covered call strategy that allowed the person the ability to still bring in credit, bring in a recurring type of revenue from their shares, but not have the risk of taking the shares away. That was the basis behind the claim. And the court said that they were wrong in promising that. Did I kind of explain?
Right. I think what happened here. So in a covered call, what you're doing is you're buying the stock and you're selling a call, or you can look at it the other way of selling a call and buying stock. Actually, I kind of think of it that way because the trade's called a covered call. So you sell a call, and to cover the risk of a covered call, you buy stock, or sometimes we do the other, buy stock and sell a call. That's sometimes referred to as a buy right strategy. And the covered call, where people sell calls, they can generate an income, because when you sell a call, as soon as you sell the call, you receive a credit, and that's money that goes into your account. But whenever we sell options, we have obligations. So when you sell a call, your obligation is to sell the stock to somebody else, because they're on the other side of that trade is somebody who owns a long call. So people who own long calls, they buy the right to buy stock. Now, that's not always what people do. If somebody bought a call, they might sell the call later. But in the case of this woman who was selling calls to generate income, I think where the culpability came in, and I'm not an attorney here, so I don't want to, and I don't know a lot about the details here, but it sounds like she said, I don't know what I'm doing. I trust you manage my money, and you're telling me I can generate income. So great. So she wasn't actually the one making the decision to do this. It sounds like to me, she had a registered investment advisor who was saying that,
Yep.
we could avoid selling our stock. And this is something that a lot of people do, is they own an equity and then they'll sell a call. And if the stock price goes up, you can avoid, you don't know for sure when you're going to get assigned. I mean, all of us who trade short options, if you do it long enough, occasionally you get assigned early and you say, well, this doesn't make sense. I don't know why this happened. And there are reasons which we can dive into why that happens, but you as a short seller don't know for sure unless it's going to happen on expiration. And you'll probably get assigned if the option expires in the money. So if you know you're going to end up selling your stock, you don't want to sell your stock, you can roll that call out further in time. And you can generally avoid getting assigned. The problem is if the stock goes up very, very high, in order to roll that call, you have to add a lot more capital to the trade, which also increases your risk. And that's the point I wanted to bring up in here is the word risk.
Before you get to that, let me kind of summarize, I think, what happened here, and then you can go to risk versus what I know you want to talk about. This lady started acquiring shares of Apple in 97 and sold these calls against her stock that was taken away from her in 2020. And so my guess is she made a lot of money.
Yes. If she was buying in 97, she was probably buying Apple when it was at like $6 a share.
And yet won a lawsuit based off of risk. So
and she made money. I don't know why this isn't loading up here. I have a subscription to Barron's. Maybe it's not. Sign out. Sign in. Barron's, by the way, is one of my favorite, weekly reads. I enjoy reading it on Saturday. Or sometimes I read it on Sunday with my wife. Darn it, that link's not coming up. That's weird. Let me try this again. Yeah, it's not loading. I think I have a PDF of it here. So were we going to talk about that risk thing right now? Is that
while you're loading up? Yeah, while you're loading up, I can kind of prime the pump as to I know what you're going to talk about here in a little bit about. This really is a discussion about, I believe, the misuse of the term risk by, honestly, in this case, by a court and FINRA. Because, in fact, let's be honest, it actually wasn't a court. It wasn't judges. I'm looking right there. This is a 3-person FINRA arbitration.
Yeah, it's an arbitration.
So this is just a misunderstanding of 3 people that work at FINRA of risk versus the risk versus opportunity cost, I think is a better discussion.
Right. So I have a PDF of it that I saved. So so I wanted the key that I wanted. So there's this word, this is the phrase that got me here. Cautionary to other, the risk of option trading, and the term, she did not want to sell any of her shares and risk of losing any, according to her. So what they're saying here, what the author writes in here is this strategy involves risks such as the stock soaring above the call price, resulting in the option holder exercising their option to buy the stock and the seller missing out on the gains above. So I think the word risk is used in different contexts here. When we think about risk from an investing standpoint, I think about loss, and risk actually is more than just one number. It's a dynamic number. It's a consequence times a probability. So what's the likelihood of something happen? And the analogy I use sometimes is, crossing the street. If you walk across the street, what could happen to you? And you might get grazed by a car, you might get scared by a car, you might get hit by a car, you might get bruised, might break a leg, you might die. All of those are risks. So what's the likelihood of you dying? Actually, it's 1 in 14,000 years. If you cross at a crosswalk, the probability of you dying is 1 in 14,000. That's an acceptable risk. Getting hit, there's probably a higher probability. I don't know what those numbers are. But when we talk about financial risk, we're talking about losing money and missing opportunity. I think the word, it's not financial risk, and we could probably say missing out on an opportunity. Substitute, you've missed out on a greater opportunity here, and everybody would agree, yes, that's true. She missed out on potentially making more money. But this is one of the things that I think misleads people here. When we talk about the covered call, the maximum profit is achieved when, Greg?
That's when you get assigned.
When you sell your stock, that's where you make the most money on the trade. And is that a risk?
Well, when you went on Let's Make a Deal with Monty Hall, was it a risk to give up the $10,000 cash for what's behind door number 2? Yeah, I mean, theoretically, but if I walk away and say, no, I'm taking door number 1, I'm taking the 10 grand, it's a bird in the hand, right? It's a known gain. And that's what I view a covered call as well. Could the stock keep going higher? Sure. Could I make more money? Sure, but it's an unknown.
Let me ask you a question.
Yeah.
If you were one of these, so these people that say you should avoid assignment, and by the way, there's a lot of them. In fact, most professionals. I was listening to a podcast with a couple very well-known national personalities in the financial space, one of whom referred to the covered call as the worst strategy that a retail trader could do. And afterwards, I had a conversation with these people. So why'd you say that? They said, well, you're going to end up selling your stock. I said, well, where do you make the most money? Well, if you sell your stock. And so why is that a problem? Well, you could have made more money. And I think the person who refuses to accept assignment probably would never, because the argument is, I could have made more money later. So if I sell my stock now, I have a bird in the hand, I'm going to make a certain amount. And by the way, to put that in a box, maybe 5% or 8% return on risk in a month on your capital, on your risk, is very realistic. To say, I've got a high probability of making money and making easily 2%, 5, 10, 8%, somewhere in that range is not crazy at all. And by the way, if you're making 10% or let's say 5% in a month on an annualized non-compounding basis, that's 60% annualized return. If you make 5% a month on your capital, 60% annualized return. And by the way, the probability of you making money, the problem is you're going to sell your stock. And back to my argument here with the people who say I would avoid getting assigned on my covered call, those people would never sell their stock anyways because they're not stock traders. Yeah, what are they, Greg? What are they?
They're buy and hold investors with the hope that, it is the next Apple. And I think it's ironic that this is the stock that's being pointed to right now. And that's not to say there can't be a few others, Amazon it would be another one that you could throw in there, or Google, or, Activision type of situation.
Well, Greg, let me ask you a question. What is that over your right shoulder sitting on your desk?
One of these baseball cards? Yeah. Is that what you're talking about?
Yeah. Baseball cards. So why?
This is a Spencer Strider rookie for you Braves fans.
Why do you invest in baseball cards, or?
No, it's a hobby. I love baseball, but one of my claims to fame is I've been to all 30 baseball stadiums. And watch the game there. I love baseball. This is a hobby I do. I don't invest in baseball cards.
But do people treat their stocks the same way?
Unfortunately, yes.
Yeah. I think that's a real question for those of you that are interested in or have done the covered call. I see a lot of people who will enter a covered call and then do everything they can to avoid assignment. And I get it. If you bought the stock at 100 and it dropped and you sold a call, say at 80, you'd end up, losing 20 or something like that on the trade. So I can understand avoiding, but closing for a profit. I think a retail trader would do very well to look themselves in the eye and say, hey, if I bought this stock at 100 and I sold it for 110, and I sold that call for $12, for $2. So I'm going to make $12 on this trade. That's a 12% return. Are you happy making 12% in a month? And if the answer is yes, then let it get assigned. Yeah, and the reason is because the stock may go up higher. It may drop back down out of the money. And if it drops out of the money, then you sell another call. I think we run into too many people who are not in this to make money. They're in this because it's a hobby, like collecting baseball cards or fine wine or something else. They don't do this to make money.
Yeah, or they've got a misconception about the idea that I'm going to buy and hold Apple. And can you do that? Yeah, you can. But that's a rarity, because you could have decided at the time 20 years ago, at the time when Apple was kind of not that great of a company, and the king of the world was GE. And you could have put all your money in GE and said it's the most fundamentally sound company out there. They're diversified across all these different asset classes. And I'm going to buy and hold and put all my assets in GE. And where would you be today? You'd be lower. And so the hard part of the buy and hold strategy, and I'm not against some strategies of buy and hold, by the way. I think for some investors who don't want to manage their money, the best way to passively invest in the market is to go buy an index mutual fund, to go buy shares of the SPY, and then buy and hold that. But you can make a lot of money if you trade stocks, not buy stocks and hope that they're the next Apple. And that's not to say I haven't been into Apple for the last 20 years. I have. I've been in and out and in and out, and I've made a lot of money trading Apple. But you said it before we started today, there's not a stock in my portfolio that I wouldn't be willing to sell next month if I got assigned on a covered call.
No, I think I have this argument. I've had this conversation, and I'm not exaggerating it. Probably I wouldn't say 1,000, but realistically 100 times or more. I've had this with people that we work with, and there are valid reasons to not selling your stock. The first I mentioned is you lose money. So if I lose money, the other might be a tax consequence. And we have one person who is a very high net worth person who has a lot of Apple and was asking me, hey, Apple's run up and I want to avoid assignment. I had this conversation of why would you want to avoid assignment? You're going to make money. And he says, listen, I'm in the, I'm in a 39% tax bracket. If I close now, this is in a cash account, I'm going to pay taxes. Next year I retire and my income's going to be much lower. And so I can have a significant benefit. And we help do the math on what the difference is. There's also the difference between long-term and short-term capital gains. So if you had it less than a year, it might make sense to, and I've done this myself where I've rolled it, adding debit to the trade to just so that I can make the trade a long-term capital gains. The other reason, like I've done Tesla before, I wanted to go the shareholder. This was pre-COVID. And so I didn't sell I didn't let my call get assigned because I needed to be a shareholder to go to the meeting. Same thing with Berkshire Hathaway. I did go to that shareholder meeting. I think there should be very rational, logical reasons as to why you're not letting your stock. And I'm going to tell you that it's very liberating when you will allow yourself to be assigned and to make money, because you can get right back into the stock again with some other strategy, or maybe there's a better equity. And like I said, there's places for buy and hold for some people. But for me personally, there's got to be a price that you have to be willing to sell your stock. And I would think every investor rationally would say, yes, every asset that I own, there's a price that I'm willing to sell this for. And that should be based on a logical understanding and some math. So there's a price for everybody. And I think it behooves everybody to understand what is that price level, and taking profit is not anything to be ashamed of. And you take that risk off the table and then you can make money. And this has been a great year for me. Actually, I've done very well with the markets being down personally. So, by the way, so people who want to learn more about covered calls, OptionsANIMal does a free webinar. There happens to be one tomorrow. I don't know if you'll get to see this video in time. So today is the 23rd of August, 2022. Tomorrow there's a free webinar for anybody, but we'll put a link down below on how you can get on future events to learn more about the strategy.
And the other thing I was going to point out here is I think the misconception with the covered call itself is thinking of it as a static strategy too. One of the unique things that we specialize here at OptionsANIMal is teaching people the idea of adjustments. And, this risk that they're highlighting in this lawsuit is that the risk that she allowed her covered calls to get assigned. Now, she wasn't actively managing it. So from that standpoint, their advisor wasn't doing the things that they could have done to avoid assignment, which are really simple adjustments that we go into detail. Now, I'm not going to go into detail in this podcast, but that's what our business model at OptionsANIMAL is teaching people this idea that you can go into any type of option strategy, whether it be a covered call, whether it be a credit spread or a debit spread, or even just straight long options. And if the trade does go against you, and whether it's assignment risk or whether it's going the wrong way and you're losing money, you can make an adjustment to that trade to fix it. So that's probably, Eric, why you and I are both comfortable with this concept of this covered call idea, because we realize that, why didn't you just roll them? Why did you let them?
Well, I think the reason is because Apple had this meteoric rise, and rolling would have required her to come up with more capital, because they were probably so far in the money that she couldn't roll them, that there was no extrinsic value. That's what I think. And I don't know if we should feel bad for Mrs. Fernback, Ms. Fernback. She ended up selling the stock and booking a profit of $420,000, and then was awarded another $800,000. So she should have done pretty well. I think in hindsight, she's like, I could have made more. Would be her argument. By the way, this was after 50 hearings. I wonder.
Well, I was going to point out right there, it looks like the attorneys made as much as she did.
Yeah, the attorneys did pretty well too on this. So compensatory damages, 300,000 attorney fees, and 40. So she, I think her point was she wanted to make sure that other people were aware of this. Was in this comment. You can find the article if you look on Bloomberg for it, but. I just thought it was an interesting discussion for our podcast here. If I was on the FINRA board, I don't know that I would have been as kind to her.
Yeah, it's hard to lose a lot of sleep over her being taken advantage of. Okay, I know we've got some other things we want to discuss. I know we want to meet later in the week too and have another one of these podcasts, but. Any final thoughts on where we're at before we wrap up?
What do you mean on where we are?
Anything else we need to talk about before we're done for the day?
I think we can save other topics for later on in the week. Okay. If you want to do that. We've got a lot of ideas, and we'd like to get feedback from people. As what strategies would you like to know more about? What topics, what issues? A couple of things just to sort of as teasers. One of them is inversed and leveraged ETFs. There's some interesting things happening in that space. I think we're going to have one of those coming up soon. Maybe a little bit of a deeper dive, getting a little wonky, talking about yield curve and yield curve control and what's happening. There's a lot of talk about an inverted yield curve for over a decade. It's something I follow. I've been talking about for quite a while. I'm not as concerned about this inverted yield curve. I can explain why in greater detail. I think we got some other ideas, and we'd love to hear your ideas. So what thoughts do you folks have, and how we can make this better? So like I said, like, subscribe, and comment below. And we look forward to seeing you again in the future. And I'll leave it to you, Greg, to wrap up.
Okay. Thanks, everybody. Look forward to seeing you at the next one.